Hey everybody, so this is part 5 of my income statement series. And in this video, we are going to talk about depreciation expense and just the concept of it. So let's say in this example right here, I am purchasing a building, and let's say that this is going to be a commercial property. Let's say I purchased this with $390,000 of cash. So what's going to happen on my financial statements? So I'm going to do something called capitalizing the asset. So what this essentially means is that this $390,000 gets moved onto my balance sheet. So on my balance sheet, there is this line item called plant, property, and equipment. So what happens here is that, I am adding $390,000 to this line item. But what also happens is that I am losing $390,000 of cash. So at the end of the day, the balance sheet isn't really changed in any way because our assets literally just moved from cash to plant, property, and equipment. So it's literally just an exchange of assets. So let's talk about GAAP depreciation. So in the United States, we have something called generally accepted accounting principles. And instead of expensing this property all at once, we expense it over its useful life. So let's say that I am a company and I decided to buy services from another company. Well, I expense that. But do I expense a property that I bought? Well, we do, but just not all at once. So, what would happen if all of a sudden, I have this income statement and I just report this massive, massive expense of $390,000 out of nowhere? And let's say I do this like every other year. Well, investors, they're going to get thrown off. They're going to be like, whoa, what's this? Where did this come from? So instead of expensing it all at once, we expense it over the useful life of the asset. And this is primarily done for income statement smoothing. So we see the smoothing effect among many different quarters of the financial statements. So let's just talk about useful life for a bit. So a lot of different governing bodies, they dictate the useful life of assets, such as commercial buildings. So the useful life of a commercial building is about 39 years. So in this example here, I very specifically used 390,000 because the commercial building has a useful life of 39 years. So this makes for a very easy calculation. So our $390,000 purchase is expensed over a 39-year period. So that's basically $10,000 a year of depreciation expense. So on the income statement, every single year we're going to see this $10,000 depreciation expense occur. So that's basically what I mean by expensed over time. Now, for financial statement purposes, a company can use straight line depreciation. And that's basically that method that we just talked about in the previous slide, where we literally just get the cost of the asset and we divide it by the useful life. So that is called straight line depreciation. But, companies, they don't necessarily need to do this for their taxes. So a company, they can essentially, for financial statement purposes, they can use straight line depreciation. And at the same time, for tax purposes, they can utilize an accelerated method of depreciation. So think about this. If I can expense more of that asset every single year and depreciate it faster, what is that doing for my taxes? Well, essentially, I'm reporting less income. So from a tax perspective, I am basically paying less tax every single year until the life of that asset is fully depreciated. So if we're talking about time value of money, we're getting more money up front because we're paying less taxes. But in the future, we're going to have to pay more taxes because we're depreciating it faster. So accelerated methods for tax purposes are giving us more money in the early stages. But in the later stages, because we're depreciating it faster, we're not going to receive as many tax benefits. So let's talk about equipment versus property. So you can also depreciate equipment too, but equipment actually loses value over time. Property, on the other hand, may actually appreciate over time. So this kind of leads to a dilemma. So many companies, they will do a reconciliation because, like I said, in with depreciation, all the cash comes out when you purchase the initial asset. So depreciation is not a cash expense because we already utilize all the cash on that purchase in the initial year that the asset was purchased. So in future years, when we're depreciating this isn't hitting our cash account. So just to clarify, the cash, it was spent when the asset was purchased. Now on the balance sheet, on the year that the asset was purchased, we reduce cash and we add property to that line item, plant, property, and equipment. So in the future, every single time we have this expense called depreciation expense, this is not hitting the cash account. The cash account was already hit. So companies, they do a reconciliation where they actually add back depreciation into their income statement. But we have to be very selective about this because, like I said, equipment and property depreciation are treated very differently. So equipment depreciation, let's just think about, let's say, for example, you bought a tractor, okay? Now that tractor, maybe it has a useful life of 20 years. And after 20 years, is that tractor worth more or is it worth less? It's more than likely going to be worth less money. It might even be completely useless. And maybe technology has outdone itself in the next 20 years and that tractor is completely useless. Nobody wants to buy it. It is a heap of junk and it actually costs you money to get rid of it. So think about a property on the other case. So 39 years later, maybe your commercial property is worth even more than it's worth right now. So maybe, basically all the commercial properties around the building, they increased in value. And maybe just real estate in general is more expensive. So the value of this property may actually go up in the next 39 years. And it's very likely that that happens. So here, companies, they may opt to add back in the property depreciation, but they may not add back in the equipment depreciation because, like I said, equipment actually loses value over time. So I hope you guys enjoyed this video, and in the next video, we're going to go over some actual examples in income statements. So have a great one and enjoy your day.